All right, in this case study, we are going to have a lot of fun. We are going to look at what was very, very close to a real life case study on my good friend, we'll just call him Ace for keeping his information confidential. We're going into nothing specific here. He might be watching this and smiling right now. So we've got a 75-year-old male we're going to look at and a funding scenario of $250,000 per year. So moving a lot of excess funds that are in safe accounts right now, looking at a fixed asset. His question is, hey, where can I put money somewhere, a safe, liquid, tax-free area that I still have access to if I want to use it, but can also leave money in the most efficient way possible for the next generation. So his specific questions were, hey, when I design the policy, like what will my cash value actually grow by? And he was shown whole life insurance policies in the past, several different options, indexed universal life products, wanted to be set up with the best possible policy. So he's moving $250,000 per year into a product, a total of $1.5 million. Goals are as follows: safe, liquid, tax-free area to position funds. Flexible funding, doesn't really need it, but likes the idea to say, hey, if I want to commit to a minimal amount and throw in more at my discretion, I like that. Not so much for myself, but if I want to kind of practice it here and there, then I can teach my kids, my coworkers, other people I coach and mentor to do the same thing. And if they need that flexibility, then I can serve as a mentor to them. This is very important to him. He is a mentor to a lot of individuals. High net worth individual. Asset transfer, estate planning. So life insurance does have a play there. After his policy, he actually looked at to say, okay, I still have excess funds here. Can I look at policies on all of my kids? Larger ones. Can I look at policies on my 15 grandchildren? Larger ones, which he absolutely could and is doing. So the first thing though is, at age 75, can this still work for me? Because I like it, I want to teach other people about it, but I've got to walk the walk. I can't just talk the talk. So, yes, it can. Here's the most important piece. And this kind of opened his eyes. It's where him and I connected, because when I first talked to this 75-year-old, very sharp individual, I thought he was a licensed insurance agent with the questions he's asking me on the phone. I'm like, okay, this guy's just trying to pick my brain for information. Come to find out, he was not an insurance agent at all. He was just knowledgeable because he's spoken with many individuals, has read a lot, watched videos, knows it quite well. And that's always admirable to see individuals dig into it. And him and I have, developed a friendship over time, and he actually has his license now because he wanted to learn more. Doesn't sell insurance full time by any means. He's got a very, very successful practice he runs, but wanted the knowledge, so he went and got his license. But to get back on track, policy design, $250,000 per year, cash value was his goal. Like, that's what he was laser focused on, optimizing the cash. So where can my money go? Base premium or PUA component? The base premium here at 10% would be what? Approximately $25,000. In the example we're going to look at, we were able to drive it a little bit lower. It's about $23,500, $23,600. We've got a term rider attached as well. But this would allow for everything else to be directed towards the PUA component. Beef up the cash value immediately. Minimum death benefit. So he is concerned about leaving a legacy, but at the same time, he wants to beef up the cash value because he's doing it for his family, friends, wants to show people, hey, it does work, here it is, that are interested in cash value. So our goal is to maximize the immediate cash value by minimizing the insurance expenses. So where I'm going with this is our MEC limit is set at $250,000. The example I've got up is going to be $251,000. But right there, and really, how we do that is by minimizing the death benefit. What is the measuring stick that the IRS uses to determine if a life insurance policy will be viewed as life insurance or a pure taxable investment in their eyes? The death benefit, an individual's age and death benefit. So we've got the policy designed, minimum expenses, funding up to that MEC line, maximum cash value, and death benefit over the long haul. I'm getting too excited. Let's take a look here at the numbers. All right. So what I like to go through here is not just jumping over. You can tell I didn't play basketball because I couldn't jump. I don't like to jump over to the non-guaranteed values, because those do look strong when we design the policy properly. Don't want to do that. Guaranteed values. Now, these are not as attractive, but it's beneficial to see. Here's how I look at it. If I'm you, we flip positions, and I'm the consumer. I do not want to only be shown the best case scenario, and then if that doesn't happen, I'm going to be upset, and I'm not going to be upset with the company. I'm going to be upset with you, most likely. Personally, I try not to be. I try and study everything first to be accountable myself. But at the same time, it's the agent's job to show this kind of stuff. So guaranteed values, which reflect the guaranteed costs. So we are utilizing a term insurance rider. When we look at the guaranteed values, this is going to assume two things. No dividends, only the guaranteed rate applied to the policy, indefinitely every single year. And then also, term riders, fees, expenses associated with the policy are charged at the maximum allowable rate. So when it comes to expenses on a life insurance policy, companies have their current expenses, which they've operated in for about 150 years, a non-guaranteed environment, but then they have their guaranteed insurance expenses, what they reserve the right to increase expenses to if they need or want to do so. So, can it happen? Yes. Will it happen? Probably not. But do I want to see it? Yeah, I want to see it. It's my money I'm putting into the product. So the guaranteed values, right off the bat, I pay in $250. I've got about $215 to show for it. Cash rich right off the bat, and a death benefit of almost $2.2 million. Why it's $2.18 million is that gives him a clean $250,000 MEC limit. Okay. So, guaranteed values, when I stop funding it, he can keep paying in, which will improve this, but we wanted to show 1.5 million and stop there. So optimized it with what we have to work with. Breaks even between years 13 and 14. Based off the guaranteed values with this major mutual carrier, that is partly due to age. We've gone through several examples. If you looked at earlier case studies or any of our video content where we can break even around year 5, depending on our age, if we're 50 or under, even at 60, you can get decent guarantees. Age does have a factor in a case like this, but again, I want to see it up front. Still appreciates over time. I do have a death benefit, paid income tax-free. Now, we've seen that. The guarantees, we've always seen products do better. Still good to set expectations. How I look at it is if I'm not okay with this and it's just not moving forward because of that, way better off for me to see that up front and make the decision that way, not to move forward when I'm putting in $250,000 per year, as opposed to find out after the fact, hey, like, why didn't you show me this, man? Come on. No, we don't want that. Now let's look at the non-guarantees. Here we go. Which, I'll state again, companies, the 4 major mutual companies specifically, and a lot of other carriers have operated in a non-guaranteed element or environment, meaning they've paid dividends, have not charged the maximum allowable rate for their fees, insurance expenses, term riders, all that stuff for the past 150 years. Let's see what it looks like. Breaks even year 5. And we've worked with a lot of individuals in their 60s and 70s, and we see the products break even as projected or very, very close, like they're performing, which is great. So, cash value continues to appreciate over time. Looks good. Now, a question that naturally comes up here is, all right, in this policy, you have a base premium of about $23,000 and a whole life death benefit initially of a little over $200,000, about $220,000. So we've got a big term rider on this thing for about $2 million. So, initial, I should say, term rider $2 million for a 75-year-old male. What thought goes through your head when you hear that or see that? It's got to be expensive, huh? Maybe we shouldn't even bother with it. I'll state this and then we'll look at the numbers. It makes more sense, if your goal is maximum cash value, to still carry a minimum base premium with a term rider attached if cash value is your goal. And the best thing to do is look at both. Look at with and without. The thing is, without a term rider, you have to raise that base premium so much higher, which no matter what you do, that will result in weaker initial, really upfront, but weaker long-term cash values as well, especially at the age of 75. So the question is, of course, $2 million term rider, how much is that going to cost? Let's look at a breakdown here. So we've got the current costs and the guaranteed costs. Guaranteed are on our left. This is why it took so long to break even. But again, beneficial to see this stuff up front as opposed to just hearing about it. $250 per year. And I was looking at samples recently for a corporate case, and I was comparing with illustrations I received in the not too distant past recently, and they looked way different. So I said, okay, what's the difference here? And the response I got back from someone was, don't compare illustrations. I'm like, well, no, I'm going to compare them, because if the client compares them, you've got to be able to have answers and know it accurately. And there could be a mistake. Like, that's how I look at it. So the point for me mentioning that is we want to treat others as we want to be treated. Show the material, full disclosure. Don't just talk about it or try and scare or deter someone away from a certain strategy that requires more work to put together. So this is more of the agent training business and coaching business we have, that kind of stuff we go through to really help elevate your practice to the next level. So funding stopped there. Term cost based off the guarantees. Here's the jump right here. Now our term rider decreases over time. How it's set up is as you pump money into PUAs, a huge PUA rider, your whole life death benefit increases. As your whole life increases, your term comes down. But if the company decides to raise the costs to the guarantees, which they haven't done, but if they do, you can see that jump initially. It's expensive at age 77. Based off the non-guarantees, you see that jump as well. The cash value, by the way, this is the net cash value. So the last slide we looked at, those were the net values, which is good. That's what we want to see. So term rider cost, slight jump in year 3. The reason why is the first 2 years, the term cost is consistent with this particular company, but then it diminishes over time as the term rider diminishes. There we go. Net death benefit over here continues to appreciate over time, which is great. Cash value does as well. So, am I too old for a high cash value life insurance policy? No, not by any means. Health does have a play. How much I can fund a policy with has a play. If I'm trying to pay in $10,000 or $20,000 at age 75, that can be a bit of a challenge. It's not impossible, but it won't look as good as the example we just had up. The reason why is we can only drive that minimum premium so low. So again, those are always samples we can look at and like to go over with everyone that we work with, just for transparency, right? Doing to others as we want done to us. But in any event, I hope that you enjoyed this case study. I did. I always have fun with this stuff. Reach out if you'd like to see any samples yourself, connect over a call with any of us. And as always, I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.